A credit score is one of the most important numbers in your financial life. Whether you are applying for a loan, renting an apartment, or even seeking a job, your credit score can influence the decision-making process. But many people are unsure about what affects their credit score, how it is calculated, or how to improve it. In this article, we will explore the key components that determine your credit score, the factors that can affect it, and the steps you can take to improve it. What is a credit score? A credit score is a numerical representation of your creditworthiness, which is the likelihood that you will repay borrowed money. It is calculated using data from your credit report, which includes information about your credit history, outstanding debts, and payment behaviors. The credit score is typically a number between 300 and 850, with higher scores indicating better creditworthiness. The three major credit bureaus in the U.S., Equifax, Experian, and TransUnion, calculate credit scores using different models. However, the most commonly used model is the FICO score, which is calculated using 5 key factors. How is your credit score calculated? Your credit score is determined by the following 5 factors, which are weighted differently based on their importance. 1. Payment history, 35%. Your payment history makes up the largest portion of your credit score, 35%. This factor looks at whether you have made your credit payments on time. Late payments, defaults, bankruptcies, or foreclosures can significantly lower your credit score. Conversely, consistently paying your bills on time helps raise your score. 2. Amounts owed, 30%. The second largest factor affecting your credit score is the amount of debt you owe. This includes credit card balances, loans, mortgages, and other forms of credit. The credit utilization ratio is an important part of this factor. This ratio is calculated by dividing your total credit card balances by your total credit limit. A lower credit utilization ratio indicates that you are not overburdened by debt, which is favorable for your credit score. 3. Length of credit history, 15%. The length of your credit history accounts for 15% of your credit score. This factor takes into account how long you have been using credit, including the age of your oldest account, the average age of all your accounts, and how recently you viewed your accounts. A longer credit history with a consistent record of on-time payments positively affects your score. 4. Types of credit used, 10%. The types of credit you had, such as credit cards, mortgages, car loans, or student loans, make up 10% of your credit score. A healthy mix of different types of credit can demonstrate your ability to manage different kinds of credit responsibly. However, this factor is less important than others, so it's not necessary to have all types of credit to achieve a high score. 5. New credit, 10%. The number of recently opened credit accounts and the number of inquiries made into your credit report can lower your score temporarily. Each time you apply for new credit, a hard inquiry is made, which may cause a small, short-term dip in your score. Too many inquiries can signal that you are taking on too much debt, which could negatively impact your creditworthiness. What affects your credit score? Understanding the factors that affect your credit score is essential in managing and improving it. Here are some of the most common behaviors and financial decisions that can have a positive or negative impact on your credit score. 1. Late payments and defaults. One of the biggest contributors to a low credit score is a history of late payments or defaults. Even a single late payment can affect your score, especially if it is reported to the credit bureaus. If you miss a payment, it is important to pay it as soon as possible to minimize the impact on your score. Defaults and other severe issues like foreclosures or bankruptcies can have long-lasting effects. 2. High credit utilization. This ratio can signal to lenders that you are relying too much on credit. A general rule of thumb is to keep your credit utilization ratio below 30%. If you consistently carry high balances on your credit cards, it can harm your credit score. Paying down your balances and reducing your credit utilization ratio can help improve your score over time. 3. Frequent credit inquiries. Every time you apply for credit, a hard inquiry is made into your credit report. While a single inquiry typically results in only a small decrease in your score, multiple inquiries within a short period can have a greater negative effect. It's important to only apply for credit when you truly need it and to space out your applications when possible. 4. Short credit history. A short credit history doesn't necessarily mean your credit score will be low, but it can affect it. If you have a limited number of accounts or have only recently begun using credit, your score may not have enough data to be considered strong. Building a long, positive credit history over time will help improve your credit score. 5. Errors on your credit report. Mistakes in your credit report, such as inaccurate payment histories, accounts listed as delinquent when they are not, or incorrect personal information, can also lower your score. It's important to regularly review your credit reports and dispute any errors you find to prevent them from impacting your credit score. Hack of improve your credit score. Improving your credit score is a gradual process, but there are several steps you can take to boost your credit worthiness. 1. Pay your bills on time. Paying your bills on time is the most important factor in maintaining a healthy credit score, as it accounts for 35% of the total score calculation. Consistently making timely payments on credit cards, loans, mortgages, and other bills helps build a positive payment history, which is crucial for lenders to assess your reliability. Even a single missed or late payment can have a significant negative impact, especially if it's reported to the credit bureaus. To ensure you never miss a payment, consider setting up automatic payments or reminders. Paying bills on time not only strengthens your credit score, but also helps avoid late fees and high interest rates, contributing to better overall financial health. 2. Reduce your debt. Reducing your debt is one of the most effective ways to improve your credit score, as it directly impacts your credit utilization ratio, which accounts for 30% of your score. High credit utilization, when you carry large balances relative to your credit limits, signals to lenders that you may be overextended financially, which can lower your score. To boost your credit score, focus on paying down high-interest debts such as credit card balances and aim to keep your credit utilization ratio below 30%. Reducing your overall debt not only improves your credit score, but also lowers your financial stress, helping you save money on interest and enabling you to manage your finances more effectively in the long run. 3. Keep old accounts open. Keeping old accounts open is a smart strategy for maintaining a strong credit score. The length of your credit history plays a significant role in your credit score, accounting for 15% of the total calculation. Older accounts demonstrate a longer track record of responsible credit use, which can boost your score. Closing old accounts, especially those with a positive payment history, can shorten your average account age and reduce your available credit, potentially lowering your score. Even if you're not actively using an old account, it's beneficial to keep it open to maintain a positive credit history. Just ensure there are no annual fees associated with keeping the account active, and periodically review the account to avoid any issues. 4. Diversify your credit mix. Diversifying your credit mix can have a positive impact on your credit score by demonstrating your ability to manage different types of credit responsibly. Credit scoring models like FICO take into account the variety of credit accounts you have, such as credit cards, installment loans, mortgages, and auto loans. A healthy mix shows lenders that you can handle various financial obligations, which can boost your score. However, it's important to diversify only when necessary. Opening new credit accounts just for the sake of improving your mix can lead to unnecessary hard inquiries and temporary drops in your score. Focus on maintaining a balanced credit profile and only take on new credit when it aligns with your financial needs. 5. Dispute errors on your credit report. This is an important step in maintaining an accurate credit score. Credit reports are not always error-free, and mistakes such as incorrect late payments, accounts that don't belong to you, or outdated information can negatively affect your score. It's essential to regularly review your credit reports from all 3 major bureaus, Equifax, Experian, and TransUnion, and dispute any inaccuracies you find. Disputing errors can be done online, by phone, or via mail, and once the dispute is resolved, the incorrect information will be corrected or removed, potentially boosting your credit score. By keeping your credit report accurate, you ensure that your score reflects your true credit worthiness. 6. Limit credit inquiries. This is crucial for maintaining a healthy credit score. Each time you apply for new credit, a hard inquiry is made, which can cause a slight drop in your score. While a single inquiry might have a minimal effect, multiple inquiries within a short period can signal to lenders that you are taking on too much debt, potentially lowering your score further. To avoid unnecessary inquiries, only apply for credit when absolutely necessary and try to space out applications. If you're shopping for a loan or credit card, try to do your research first to avoid multiple applications that can negatively impact your credit. If you found this video helpful, don't forget to hit the like button and subscribe to the channel for more tips on personal finance, credit, and financial management. Stay informed, stay empowered, and keep working towards your financial goals. Thanks for watching.